Hello everyone, welcome to Accounting 312. In this video, finally we are going to the fourth method. We call it AARR. You can see we have been talking about a lot of RR, right? Rate of return. We talk about RRR, required rate of return. You use that one to get your discount factor. For the IRR, internal rate of return, you have to set NPV as 0, and then you go to the discount factor table, you found out that the factor you look up, based on the year you look up, you found out the rate, the internal rate of return. Last one is the AARR. AARR is, I would say, a little bit different from the first three. No matter it's NPV or IRR or payback method, we focus on cash, right? We focus on cash. But this one from the name, it's your accrual accounting rate of return. So I think that's what you like, right? You like financial accounting. Finally, we are going back to our accrual accounting, AARR. So instead of focusing on cash, this is the only method in this chapter that focuses on our accrual accounting income. Okay, so we don't think about cash, we talk about income from the operation. I would say you definitely will have a question in the final exam. I put it that way. So you can say how much I want you to pay attention to this method. It's a focus on our accounting income from the operation. Formula, likely you know, you can look at this formula. So formula is your annual cash minus your, no, sorry, it's your operating income divided by your initial investment. So similar, kind of similar with your previous things, but we focus on operating income. Sorry, we focus on operating income. We focus on operating income. We use that one to divide the net initial investment to say how much your investment will generate, increase our operating income. When you learn the financial accounting, I believe when I learned financial accounting, you know, no matter 210 or I think 210. I remember last chapter is the cash flow statement, right? So when you did cash flow statement, you adjust from your operating income. So how did you do the adjustment? You help me operating income, and then how do you take care of depreciation expense? Operating income, depreciation expense will decrease your operating income, but it's a non-cash item. So you have to subtract the depreciation expense to get your cash, right? So, oh, sorry, you have to add it back. You have to add back the non-cash expense to get your cash. That part always kind of confuses me. Okay, so your operating income, add your depreciation expense, that is your cash. That is your cash, because your depreciation expense is non-cash expense. So you add it back from your operating income. Oh, this is confusing, but I think you are better than me. So from here, how do we get our operating income? Our operating income will be the cash subtract the depreciation expense. So you have to use the cash item to subtract the depreciation expense to get your operating income. That's how you do the adjustment to get your operating income. Okay, so focus on these things. So first is our operating income. How do we get our operating income? It's our cash increase minus depreciation expense. So you have to know how do we get our depreciation expense. In this chapter, I think it's very straightforward. Basically, it's your cost minus residual divided by how many years, right? Divided by how many years. So this is a straight line depreciation expense. So you have to calculate depreciation expense first, and then you get your cash to subtract your depreciation expense to get your operating income. Second, we focus on operating income. We focus on operating income. This is a big difference of this AARR and the first three one. The first three one, they focus on cash. They said, hey, no matter cash from operation or cash from what? from your, remember we learned one thing at NPV, we said that there is one thing called working capital. Remember working capital, your 30,000 will be liquidated and then become your cash inflow. When we do our NPV, when we do our IRR, when we do our payback method, we put all cash in consideration, including this liquidation of your working capital. But AARR, we only focus on operating income. We do not consider the working capital liquidation as the operating income. We only focus on operating income in the numerator. So numerator is just operating income, and then you divide by net initial investment. Net initial investment has the net initial investment has the working capital, right? So when we did the working capital, you will feel better, I promise you, after next few videos. But this time you just need to know when we did our net initial investment, we put 30,000 as cash outflow. But when we do AARR, we only put the 30,000 as outflow for the denominator, but we don't put that one as our numerator when we get the 30,000 liquidation cash back, because it's not operating income. Okay, you will say, oh, Professor, I'm a little bit confused. Teach me, right? Teach me, show me an example. I said, no problem. So let's do this hard one together. That initial investment is this much, right? That initial investment is this much. Increased cash flow is this for the first 4 years and 150. You already knew this. In the 5th year, 30,000 working capital will be liquidated and make the cash inflow. Suppose new bus residual additional depreciation this, and then asking about AARR. So let's do it together. AARR, I put the formula. It's basically your operating income minus, no, there is nothing, no minus. Operating income divided by your net initial investment. So I'll just put net investment, okay? And then how do we get our operating income? We said operating income is cash minus depreciation expense divided by net initial investment. It's already told you, so I'll just put the number 648,900. Everybody knows how do I get this number. Sorry, I don't know whether it bothers you, yes or no. Okay. And then we need to get the depreciation expense, right? We need to get depreciation expense. So I put it here. Depreciation expense is already told you there. You don't need to calculate. But in other situations, you have to calculate. Very straightforward. The initial cost minus residual divided by years. Here, I already told you depreciation expense is 120,000 every year. Okay. So now we have to think about this. How do we get our AARR? So since I have a depreciation expense, I have the denominator, my cash. Question is, my cash, the first 4 years, 180,000. The 5th year is 150,000. And then in the 5th year, your 30,000 will be liquidated and become your cash inflow. Do we take this in the numerator? Do we take this in our numerator as operating income from operation? We said this is not from your operation. So we don't take this in our numerator. Okay, this is not operation. So what we should do then? You say, hey, Professor, this is hard to do because then the cash flow will not be even. So how should I do? Then in this situation, you have to do the average. Okay, in this situation, you have to do the average. Next, I'll talk about next one briefly, but I'll leave that for you to calculate. Okay, so denominator is 648,900, and then the numerator will be the first 4 years is 180,000 from cash minus 120,000, right? Minus 120,000. So this is the first 4 years, right? This is the first 4 years. And then you plus the 5th year, 150,000. We minus depreciation, 120,000. And then we time 1 year. So you add those, but then you totally have to calculate your annual operating income. You have to think about your annual operating income. You have to think about your annual operating income. So we divided by 5 years. So we divided by 5 years. I don't have a calculator here. If you have a calculator, do me a favor, tell me what's your number. So let me check my answer also. Sorry, let me check my answer quickly with you. Sorry, give me, I should have my calculator here. Okay, so I will post the solution definitely to the definitely I posted this to the Blackboard. So let's look at this, right? So denominator is 6, 4, 8, 900. I think I did different way. So here will be 60 times 4 will be 200. Sorry, you cannot say. So here is 60, so that gives me 240 plus 30. So I got 260 divided by 5. So I got 52. Oh, why I feel a little bit awkward. I'm not confident now. Hey, this is 54. Yes, 54. Yes, I'm right. Oh, got a little bit scared. Okay, so your numerator will be 54. Your numerator will be 54 for every year. Your numerator will be 54 for every year. The way I did it here is I use operating income minus the depreciation, and then I times 4 for the first 4 years. I do this for the fifth year. I add them, so I divide it by 5. The way I did it in my note before is I got all the cash flow first, right? I got all the cash flow the first 4 years, the 5th year. Then I divided the cash flow by 5 to get the weighted average cash flow. And then I minus every year is the depreciation expense is 120,000. So you get the same answer. So you can say I didn't cheat, right? I just do it from scratch with you. So you do this, you get 8.3%, 54,000. So you get 8.3% for our AARR, Okay, it was kind of hard, right? So we do a practice together. Hopefully you feel better after several practice. You do this, calculate AARR. So let's say this question, operating income divided by your investment. I do this with you. Buying this, it requires working capital. So you buy this. Okay, so this is the cost, 600,000, right? This is the cost. And then your working capital is 60,000. So your net initial investment will be 600,000 plus 60,000. Remember, we said your working capital is a part of your initial investment. It's a part of your initial investment. Your original 600 plus your 60,000. But this will be the working capital. When you liquidate it, it will not affect your numerator because it's not operating income. And you catch saving, so you will have this much money for 5 years. Your straight line salvage value will be this. So we first need to get our depreciation expense. Depreciation expense is cost minus residual or salvage value divided by years, 5 years. So I'll just put it here. Cost is 600,000 minus 224,000 residual divided by 5 years. So what is the depreciation expense? I want to say depreciation expense. Sorry, I want to say depreciation expense. I cannot say. Sorry, I don't want to cheat. Okay, sorry. Give me 1 second. Depreciation expense. Goodness. Don't do this to me. I need to have a calculator. Okay, depreciation expense is 600,000 minus 24,000 and then divided by 5 years. So I got my depreciation expense is 115,200. Okay, 115,200. Okay, so this is my depreciation expense. My operating income will be cash minus depreciation expense. Cash is 280,200 minus depreciation 115,200. So I get my numerator 280,200 minus 115,200. I get 165,000 divided by 660,000. Okay, divided by 660,000. I got 25%. My students wish me good luck. Okay, my students, let's say, oh goodness, I got it. Cannot believe. Oh, I got it. Oh yeah, oh yeah, oh yeah, oh yeah. I'm so happy. Oh yeah. Yeah, you can imagine, right? I'm still so nervous after teaching this for 3 years. I'm still kind of AARR. Sometimes, you know, you mess up one number, you say, oh goodness. Okay, sorry about that. Sorry. So let's go back to the question, right? So first, get your depreciation expense. The tricky thing, the main tricky thing is the working capital, 60,000. Let's say, how do we take care of this 60,000? 60,000, this working capital, 60,000, okay? So first, we know it's not in the depreciation expense calculation. Our depreciation expense is just based on the cost, 600,000 minus the residual divided by years. So the working capital has nothing to do with our depreciation expense. Second, it is not our operating cash flow, right? So it is not our operating cash flow. It has nothing to do with our operating cash flow. Yes, at the end of the 5th year, we will get the 60,000 back. When you do NPV, when you do AARR, when you do payback method, you will think about the 60,000 as cash inflow. But in your AARR, it's not your operating income. It's not your operating income. So it's not included in the numerator. But it is your net initial investment. It is your net initial investment. So it is in the denominator, but it's not in the numerator. Okay, it is not in the depreciation. It is not in the working. It is not in the operating cash flow, but it's in the net initial investment. It's in the net initial investment. Okay. I think I stop here. AARR is kind of takes time to think about this, but I think the main thing is how do we take care of working capital. As long as you know that one, you should be fine. I don't want to have another video. I just want to force my way to talk very quickly. Compare the 4 method with NPV is definitely the best. We think about all the cash flow. When I say all the cash flow, is including the working capital liquidation. AARR, we said main thing is how do you calculate it? It's when the NPV equals to 0, right? And it also takes about all the cash flow, and then we also kind of compare IRR with the RRR. We said when RRR is larger than RRR, that means your NPV is positive. So think about all the relation. Those two are cousins. Payback method, we talk about if it's the uniform or non-uniform, and then how do we do the discounted payback method, and then it's all the cash flow. The 4th one is the AARR, so it's your operating income from your operating cash flow. So it's your operating cash flow minus your depreciation expense. It's your operating cash flow minus your depreciation expense. And then if there is a working capital, we put that as our denominator. Okay, finally, we are done for the first part of chapter 21. Work really hard. Let me know if you have any question. Thank you for finishing this long video. Thank you.